Kevin OLeary has warned about the possibility of a Toronto real estate bubble. This has to do with the fact that as home prices go up at a fast rate, fewer people can afford to buy homes, which means less buyers for the available housing inventory. The lack of buyers slows down the overall real estate activity, and this can lead to a decrease in home ownership, particularly among first-time buyers. So before getting into what Kevin OLeary had to say about the current real estate market, I wanted to share with you a few recommendations on how you can navigate the current market as a potential home buyer. As a home buyer, you should be keeping up with the interest rates. With the first interest rate cut in 4 years that happened in June, we're also forecasted to see several more interest rate cuts throughout the rest of this year. Watch closely for these announcements from the Bank of Canada. You can find out in the news or by following me on YouTube. And if you try to time your home purchase around these rate cuts, you could potentially get yourself a lower mortgage rate. And a lower mortgage rate means you have lower borrowing costs and also lower interest payments. But keep in mind that the mortgage rate you get approved for, between the time you get your approval and when you close the deal, mortgage rates could drop even more, so be sure to ask your bank or your mortgage broker to keep a close eye on this for you. Most closings are going to be about 2 to 3 months long, and a lot can change in the market between that time. Next, you also want to consider long-term affordability. Just because you're approved to buy your home today, it's great that the lender thinks you can make your payments and that you're a low-risk borrower, but at the end of the day, you also have to be sure that you're going to be able to support your monthly payments, your property taxes, which also go up every year, and any maintenance fees you have, and your utility costs. Clearly, housing costs go beyond the initial purchase price, and that's something to keep in mind. So make sure when you're assessing your personal finances, you're not doing this too conservatively. If you're budgeting $100 per month for your home internet and your cell phone, maybe bump up the number to something a little bit more aggressive, like $125 a month. Play around with the numbers or get the help from a mortgage broker in case numbers aren't your thing. A mortgage broker can also take into account the potential for any interest rate changes and create a buffer for the potential of increased expenses. But at this rate, it looks like mortgage rates are going down this year anyway. You can also look for motivated home sellers. There's a wide speculation that a large number of homeowners are going to be forced to sell their homes this year and over the next couple of years because their payments are going to catch up to them. That happens when they need to renew their mortgage. You can find a better deal on your next home if you know the seller's motivated. But how exactly do you know if the seller's motivated? There's usually a couple of tells, and it's not as simple as the seller saying that they're in a rush to sell their home. A seller in most cases will not flat out say this, since it hurts their chances of getting the best price for their home. And figuring this out comes with experience, so make sure you're talking to your real estate agent. If your realtor knows that the seller is motivated, then there may be a chance to negotiate a better deal. If you're an investor, then now's the time to focus on positive cash flow. Make sure your rental income can cover your borrowing costs, also your property taxes and maintenance costs, especially as interest rates fluctuate. I think right now, if you were trying to get into the market as an investor, you can anticipate your mortgage rate to come down, which should help you with your cash flow. The Bank of Canada is set to announce a few more rate changes this year, and they're all forecasted to be rate drops. If not, then at least the worries of increasing interest rates are starting to go away. If you're trying to put your cash to work, then also consider exploring other markets within and outside of Ontario. Some provinces like Alberta and Saskatchewan are showing stronger performance, so exploring options in these more affordable and resilient markets might present better opportunities. There's still opportunity if you're keen on sticking to the real estate market in the GTA. The latest RBC economics report provides a comprehensive overview of the Canadian real estate market, projecting what they call a tale of two halves for 2024. And what they're saying is that for the first half of 2024 was expected to see continued slow activity and softer prices. And this is exactly what happened due to the Bank of Canada maintaining high interest rates. Homeownership was challenging for many potential home buyers due to affordability issues and for existing homeowners who were renewing at higher mortgage rates. But in the second half of this year, we could see a potential pivot towards further interest rate cuts. We've already had one in June, and there's a potential for more to come. RBC is forecasting the key interest rate to go down to 4% by the end of this year. And by the end of next year in 2025, they're forecasting the rate to go down to 3%. Rate drops and news like this could reinvigorate the market as buyers react to this positive news. The shift within the pool of potential home buyers is expected to release pent-up demand, and this could lead to a gradual increase in market activity in the latter half of the year. But just be careful, because more sales activity eventually leads to higher home prices. The Canadian real estate market recovery isn't going to happen at the same pace across all provinces, and provinces like Alberta and Saskatchewan are already showing signs of an uptrend, with expected above average growth in the resale market. But provinces like BC and Ontario are likely to experience more modest rebounds due to high homeownership costs with higher average home prices. RBC is forecasting Canadian home prices to go down 1% in 2024, which we've already seen. But the recovery projected for 2025 is expected to be an average home price increase of 3.1%. But how do you know if now is a good time to get into the market? Home prices are lower compared to a year ago. Interest rates are high, but starting to slowly come down. Deciding to buy a home right now depends on a few things, like the current condition of the market, personal financial stability, and long-term goals. So to help with some clarity, here are some of the reasons why you might want to wait before getting into the market. First reason is obviously the high interest rates we still have. The Bank of Canada only started to change this after 4 years of increasing and holding the key interest rate. This made mortgages more expensive and reduced affordability. Waiting for potential rate cuts throughout the rest of this year could result in lower borrowing costs. And the second reason is that the market could be cooling down still. The anticipation of more housing supply to choose from, with the potential of more home sellers due to unaffordable mortgage rates at the time of the renewals, could add more inventory, and the current market is experiencing slower activity and softer prices. And in Toronto, where we have high home prices, we've already seen prices go down by 1% compared to last year. Waiting for the potential of more inventory could allow you to take advantage of further price reductions as the market stabilizes. Finally, if you're keen on taking the least amount of risk possible, then waiting could work out in your favor. There's still a good amount of uncertainty within our economy, with potential changes in government policies that can impact the Canadian housing market. By waiting, you can gain more clarity on these factors and make a more informed decision. But if you're on the other side and you're thinking that now is a good time to get into the market, then here are some of the reasons that reinforce this idea. The biggest one is that if your personal financial circumstances allow you to get into the market right now, then there really isn't anything stopping you from reaching your goal. If your job is stable and you can bank on your income being steady, and you have a good amount of savings and emergency fund available, and the long-term plan is to stay in the property without any plans to sell in the next couple of years, then just go for it. The last one is pretty important. If you don't plan to sell, then the market value of your home shouldn't matter too much. You're not taking a loss or a gain unless you sell, so any drop or increase in market value is only on paper and doesn't impact you. RBC mentions that personal readiness can outweigh market timing in many cases, and I think this is very true. Getting into the market now based on the current conditions will also give you more negotiation power. There's a higher chance today of encountering a home seller who's more motivated to sell because of the pressure of renewing at a higher rate. In 2 years from now, I doubt you'll have the same chances of running into a homeowner who will be as motivated to sell. Today and over the next couple of years, homeowners are going to be seeing their payments go up. Someone responded to one of my recent videos and said that their payment went up from $2,400 to $4,000 per month. Their rate went up from 1.98% to 5.49%. The reality is that not every homeowner is going to be able to come up with an extra $1,600 per month, and they'll be forced to sell their home as a last resort. As a home buyer, that's an opportunity for you. And you might want to consider getting into the market sooner than later because of the pent-up demand. There is a significant amount of buyers out there who have been sitting on the sidelines waiting for rates to drop, and a single rate drop isn't going to have them all rushing back into the market, but the floodgates are open. Buyers are now watching closer than ever, with the potential for more rate drops to come, and the next one possibly coming at the end of July. Pent-up demand could drive prices up over time once the bank's interest rate goes down a few more times. Getting into the market before getting caught up in a buyer frenzy is like beating the storm and getting home before it starts pouring down on you. If you're familiar with the show Shark Tank, then you know Kevin OLeary. He's a Canadian businessman and investor, and also expressed various views on the real estate market in Canada over the years. He recently warned about the possibility of a real estate bubble in major Canadian cities like Toronto and Vancouver, specifically these two markets because of the rapid increases they've seen in their home prices. And prices tend to go up over time, but on a strong bull run, they'll eventually come down a little bit for a correction, which is what he's suggesting we're going to see. He also emphasizes the impact that the Bank of Canada's decisions on interest rates can have on the real estate market. He argues that the low interest rates have inflated the property market with high home prices several years ago when mortgages were easier to get. But he also cautions that rising interest rates could cool down the market and make it harder for buyers to afford homes, potentially leading to a downturn. This would be a result from having more inventory and homes sitting on the market for longer. He also references government policies related to real estate, such as foreign buyer taxes and mortgage stress tests. These measures can have both positive and negative effects on the market. It can cool down the real estate market that's heating up, but could also slow down economic growth. For investors, he acknowledges that there are risks associated with real estate investments, but he also highlights the potential for profit with rental properties. The two things to focus on when considering investment properties are positive cash flows and properties that are located in stable areas. The choice to invest, buy, or sell real estate is always your decision at the end of the day, but let me know in the comments which side of the fence you're leaning towards for the rest of this year. Thanks for watching, and I'll see you in the next video.